Hello and welcome to today's tax intent topic, property investment. This webinar explains some key principles relating to the taxation of property investment. It is intended as an introduction only, as it is not possible to cover all aspects of property taxation in a single short webinar. Nothing is to be taken as advice, and suitable professional guidance should be sought in all cases. Please note as well that this webinar was recorded on 7th January 2020, so before Sajid Javid's first budget on 11th March. Here is the list of areas I am going to cover. Property ownership and taxation. In considering ownership of property, I am assuming that the legal owner and the person entitled to benefit from the property rents and proceeds on a future sale of the property are one and the same, so the position is straightforward. The tax position will, however, be different where this is not the case, say where one person owns the property legally, but for the benefit of themselves and another. Where a property is owned by a married couple or civil partners, the income is automatically divided equally between them for tax purposes, unless they would be entitled to a different proportion of the sale proceeds on a future sale of the property. In this case, a declaration can be made to HM Revenue and Customs to be taxed on the same proportion of rental income as they would be taxed on the proceeds of sale. Given that transfers within a married couple or civil partnership are generally tax neutral, property ownership and entitlements can be readily changed to ensure tax efficiency based on circumstances at the time. Transfers between persons not in such a relationship will generally trigger a deemed disposal for capital gains tax purposes, and so there is not necessarily the same freedom if the property has increased in value. Income tax. A taxpayer is taxable on rents receivable less deductible qualifying expenses. These include items such as repairs, insurance, management expenses, accountancy expenses, and certain legal costs. In the specific situation where furnished rooms are let out in the occupier's own home, the first £7,500 of rental income, or £3,750 each if the property is let jointly, is tax exempt. Above this, one can either deduct £7,500 or £3,750 as appropriate, or the actual expenses to arrive at the taxable amount. Expenses will, however, need to be restricted to reflect that it is not the whole property which is rented out. Finance costs. I have already referred to certain deductible expenses, but I specifically did not refer to finance costs. This is because from 6th April 2020, no tax relief is given by way of a deduction from rental income, but via another, less favourable mechanism, i.e. as a tax credit against tax payable. These rules have been gradually introduced in the past few years and will be fully effective from 6th of April. Let us imagine now, after 5th of April 2020, that a 40% taxpayer has £10,000 of interest charges in a year. Rather than deducting £10,000 of interest from his rents to obtain 40% income tax relief, i.e. a £4,000 reduction in his tax bill, he is instead taxed on rents before deducting that interest cost and is then given a credit of just 20% of the finance cost against the tax due, i.e. a tax reduction of just £2,000 on a finance cost of £10,000. At its most extreme, an individual can end up paying more tax than they have made profit. There may also be other tax consequences from this rule. Planning to avoid or reduce the effect of this provision is therefore a significant live concern. Capital gains tax. This has to be considered whenever there is a sale of a property, or a gift of a property, or a transfer for less than full consideration, other than between spouses and civil partners. For tax purposes, the gift of a property or the sale at undervalue is treated as a disposal and is taxed as though the property has been sold for market value. The gain is then divided between the joint owners making the disposal according to their entitlements to the proceeds of the sale, from which they can then deduct their own capital losses or annual exemptions if these are available. In the case of residential property, the rate of tax applied is 18% for a basic rate taxpayer, 28% for a high rate taxpayer, or a mixture of the two rates if the taxable gain straddles the income tax higher rate threshold once it has been added to the individual's taxable income. This is slightly a difficult concept to grasp, so I shall give an example. Let us say someone has £30,000 of taxable income and a £50,000 capital gain. The aggregate of these two figures exceeds the higher rate threshold for income tax, so only part of the gain is taxable at 18%, with part of the gain being taxed at 28%. For commercial property, the rates are 10% and 20%, respectively. Furnished holiday lets in the UK or EEA. Let properties in the above locations which meet the necessary short-term letting rules may attract a capital gains tax rate of just 10% on the profit on sale. This is the case if the conditions for entrepreneurs relief are met. The relief is generous, cutting the rate from 28% to 10%, but the rules are complex. Suffice it to say that if the conditions can be met for a minimum of 24 months leading up to the date of sale, the 10% rate might be available. Specific advice should, however, be sought on this relief, and this should be done well in advance of the sale because of the qualifying period. Another capital gains tax benefit enjoyed by furnished holiday let owners is that capital gains on their disposals can be rolled over into new qualifying acquisitions, so that the capital gains tax is deferred and potentially even avoided. At this point, I must mention VAT. The issue here is if the rental activity meets the necessary conditions for the favourable entrepreneurs relief, VAT might need to be charged on the rents. This will depend upon the level of the rents and other vatable income. Inheritance tax. A key point to make here is that although renting out property might be a business, the value of the property itself or that of shares in a wholly property investment owning company will not benefit from any inheritance tax relief, and so will be liable in full to 40% tax on death. This also is likely to apply to furnished holiday lets, even though they benefit from a favourable capital gains tax treatment. Unfortunately, there is not scope to explore this further here, but more information will be included in a future inheritance tax webinar. Stamp duty land tax. This is now a significant consideration when thinking about buying residential investment property. This is because there is a 3% addition to the normal rate of stamp duty land tax, where at the end of the day of completion of purchase, the purchaser has an interest in more than one property. This would apply, for example, where someone owning their own home purchases their first investment property. This rule is very widely drawn and can apply in cases such as where one purchaser already owns an interest in a residential property and is only acquiring a small interest as a co-purchaser. This purchase of a small interest would taint the whole purchase price for the purposes of the additional rate. The additional rate will also apply where one spouse or civil partner owns a property and it is the other spouse or civil partner which is making the purchase of the investment property. There are, however, some useful stamp duty land tax rules in cases where more than one property is being acquired at the same time. This might include a main house which has an annex, or the property being purchased includes non-residential property. In the right circumstances, these can provide a very useful saving. Ownership structures. I touched briefly upon simple joint ownership arrangements earlier in this webinar in relation to spouses and civil partners, but similar income sharing arrangements can apply for tax purposes where there is a partnership arrangement or where the properties are owned by a company. In the case of a partnership, each individual pays income tax on their share of the profit. Corporate ownership can be attractive as well, particularly for larger portfolios, because companies currently pay tax at just 19% on their profits, and the individuals only pay income tax on what they draw out. If profits can be retained within the company, net of just 19% tax, this can provide a more efficient basis for funding new investments or debt repayment. Further tax benefits can also be achieved by using a company to own property, and these include the ability to make pension contributions and also through wide share ownership within a family, perhaps even using a trust for, say, school fees planning in the right circumstances. It will not, however, be suitable in every situation, and the long-term implications as well as the short-term benefits must be explored before the company is formed and the property is purchased or acquired otherwise by transfer. As always, detailed advice is required if you are thinking of transferring a property or portfolio to a company, because this might trigger capital gains and stamp duty land tax on the property's market value. Well, that is all I have time to cover today. I hope that you find it interesting. We welcome your comments, so if you do have any feedback, please do get in touch with us. Thank you for listening, and goodbye.